Let me ask you something that might make you uncomfortable. Right now, as you watch this, do you have money sitting in your bank account doing absolutely nothing? Maybe a few £1,000 in your current account, perhaps a bit more in savings, earning what, 0.5% interest if you are lucky. Here is the brutal truth nobody wants to tell you. That money is dying. Every single day it sits there, it loses value. Not slowly, not eventually, right now. And if you think I am being dramatic, stick with me for the next few minutes, because what I am about to share with you will fundamentally change how you see money forever. Most people treat money like a possession, something you earn, something you hold on to, something you protect. But that is the first mistake. Money is a tool, and just like any tool left unused in a shed, it rusts, it deteriorates, it becomes worthless. The wealthy understand this at a level most people never reach. They know that money must work, must move, must multiply. The moment it stops, you start losing. Think about it this way. Imagine you own a racehorse, a magnificent animal capable of winning races and earning you serious money. But instead of entering it into competitions, you keep it locked in a stable. You feed it. You care for it. But you never let it run. That is exactly what you are doing when you leave money idle in a bank account. You are keeping a champion locked up while the race goes on without you. Now I know what some of you are thinking, but my money is safe in the bank. I am being responsible. I am being cautious. And I respect that thinking. I really do. Security matters. But here is what they do not teach you in school. There is a massive difference between being safe and being smart. Safety without strategy is just slow financial suicide. Let me tell you about inflation. Not the boring textbook definition, but what it actually means for your life. Right now in the UK, even with inflation cooling down from where it was, your money loses buying power every single year. That means the £1,000 you have today will buy you less next year, and less the year after that. If you earned £10,000 5 years ago and stuffed it under your mattress, that same 10,000 today buys you maybe £8,000 worth of goods. You did not spend a penny, yet you lost £2,000. The invisible thief called inflation walked right through your front door and robbed you blind while you were sleeping. But here is where it gets interesting. The wealthy do not just protect themselves from inflation. They use it. They understand that in an inflationary environment, debt becomes cheaper and assets become more valuable. While your cash loses value, their property appreciates. While your savings shrink in real terms, their investments grow. They are playing a completely different game with completely different rules. I want to share something with you that changed my entire perspective on money. There was a man I knew years ago, worked his whole life as a teacher. Decent salary, nothing extraordinary. When he retired, he had about £80,000 saved up. He was proud of that, felt secure. He kept it in a standard savings account because he thought that was the sensible thing to do. 10 years later, that 80,000 was still 80,000 in numbers. But in terms of what it could actually buy, what it could actually do for him, it had shrunk to maybe 60,000 in real value. He had worked 35 years to save that money, and simply by being cautious, by being safe, he lost a quarter of its worth without spending a single pound. Now contrast that with another person I knew, started with far less money, but understood one critical principle. Money must have a job. Every single pound must be working. Some of his money worked in stocks. Some worked in bonds. Some worked in a small rental property. He did not get rich overnight. But 15 years later, his wealth had genuinely grown. Not just in numbers, but in actual buying power. Same starting point, same time period, completely different outcome. The only difference was understanding. You see, the game has changed. We are living in 2026, and the old rules simply do not apply anymore. Your parents might have told you to save money in the bank, and you would be fine. That worked in their time when interest rates were 5, 6, 7%. But those days are gone. The financial landscape has shifted beneath our feet, and most people have not noticed. Here is where most people get it wrong. They think investing is gambling. They think putting money to work means taking wild risks with everything they have. But that could not be further from the truth. Real wealth building is not about luck or timing the market perfectly. It is about understanding how money flows through the economy and positioning yourself in that flow. Let me paint you a picture. Imagine the economy as a giant river. Most people stand on the banks watching the water rush past. They keep their money in their pockets, safe and dry, never letting it touch the current. Meanwhile, the wealthy have built boats, rafts, water wheels. They have their money in the river, moving with the current, generating energy and momentum. Yes, there are rapids. Yes, there are rough patches. But the river always flows downstream, and those who understand the currents always move forward. The biggest lie you have been told is that you need to be rich to invest. Absolute nonsense. You need to invest to become rich. There is a fundamental difference. 20 years ago, maybe that was true. Maybe you needed thousands to open a brokerage account or buy into a fund. But we are in 2026 now. The barriers have crumbled. You can start investing with £50, with £20. Some platforms let you begin with whatever spare change you have in your pocket. But here is the critical part most people miss. It is not about how much you start with. It is about starting and staying consistent. I have seen people turn £200 a month into life-changing wealth over 20 years. Not through luck, not through picking the next big stock, through consistency, through understanding compounding, through letting time do the heavy lifting. Compounding is the closest thing we have to magic in finance. Einstein allegedly called it the eighth wonder of the world, and he was absolutely right. Here is how it works in plain English. When you invest money and it grows, you earn returns. But then those returns start earning returns. And those returns on returns start earning their own returns. It snowballs. It multiplies. It becomes exponential. Let me give you real numbers because abstract concepts mean nothing without concrete examples. Say you invest £5,000 today and it grows at an average of 7% per year. Not unrealistic for a diversified portfolio over the long term. In 10 years, that 5,000 becomes nearly 10,000. Not bad, but here is where it gets wild. In 20 years, it becomes nearly 20,000. In 30 years, it becomes over 38,000. You put in 5,000 once, never added another penny, and it multiplied nearly 8 times. That is compounding. That is your money working while you sleep, while you eat, while you live your life. Now imagine you did not just invest once. Imagine you added just £100 every single month, same 7% average return. After 30 years, you would have over £120,000. You personally contributed $36,000 over those 3 decades. The other $84,000 came from growth, from compounding, from your money doing what it was designed to do. Work, but timing matters, and this is crucial. The earlier you start, the less you need to contribute. Someone who starts investing at 25 and puts away £200 a month until 65 will end up with vastly more wealth than someone who starts at 40 and puts away £500 a month. Same retirement age. The early starter contributes $96,000 total. The late starter contributes $150,000. Yet the early starter finishes with significantly more. Time is the ultimate multiplier. This is why leaving money idle is not just inefficient, it is devastating. Every year you wait is a year of compounding you lose forever. You cannot get it back, you cannot make it up. It is gone. And the cruel irony is that the people who can least afford to lose time are the ones who wait the longest. They think they need to learn everything first. They think they need the perfect moment. They think they need more money before they begin, all while the clock ticks and opportunity slips away. Now let me address the fear because I know it is there. What if I lose money? What if I pick wrong? What if the market crashes? These are valid concerns, and I am not going to dismiss them. Markets do crash, investments do lose value sometimes, but here is what the data shows us across decades, across centuries. Markets recover, economies grow, human innovation continues. Over any 20-year period in modern history, diversified investments have produced positive returns. Not sometimes, every single time. The key word there is diversified. You are not putting all your money on one horse. You are not betting everything on a single company or a single sector. You spread it across hundreds or thousands of companies, across different industries, across different regions. When one goes down, others go up. When one sector struggles, another thrives. You are not trying to beat the market. You are trying to be the market. Think about the biggest companies in the world right now. They provide products and services that billions of people use every single day. When you invest in a broad index fund, you own tiny pieces of all of them. Every time someone buys a product, uses a service, makes a transaction, you benefit. You become a partial owner of the engine that drives the global economy. And here is something most people never consider. When you leave money in a bank account, you are still investing. You are just making a terrible investment. You are lending your money to the bank at almost zero interest while they turn around and lend it to others at 5, 6, 7% or more. They invest your money in mortgages, business loans, credit cards. They make enormous profits from your cash while giving you virtually nothing in return. You are already taking risk by keeping money in the bank. You are just not getting rewarded for it. Let me tell you about Sarah. She is a nurse from Manchester. Single mom, 2 kids, nothing fancy about her situation. 5 years ago, she had about £3,000 sitting in her savings account. She was terrified of investing, thought it was for people in suits who understood spreadsheets and stock tickers. But she started reading, started learning, started understanding. She opened an investment account and put 2,000 of that 3,000 into a simple global index fund, kept 1,000 as emergency cash. Then she committed to investing just £75 every month. That is less than what most people spend on coffee and lunches out. Fast forward to today. Her investments are worth over £9,000. She contributed about £5,500 total over those 5 years. The rest is growth. But here is the beautiful part. She sleeps better now. She feels more secure. She knows she is building something real for her kids. She is not rich. She is not driving a fancy car. But she has fundamentally changed her financial trajectory by doing one simple thing. She put her money to work. The wealthy have always known this secret. They understand that cash is a depreciating asset in an inflationary world. They keep only what they need for immediate expenses and opportunities. Everything else is deployed: real estate, stocks, bonds, businesses, commodities. Their money never stops moving, never stops working, never stops multiplying. And before you think this is just about stocks and shares, let me broaden your perspective. Putting money to work means different things depending on your situation. Maybe it is investing in your education to increase your earning power. Maybe it is starting a side business that generates additional income. Maybe it is buying tools or equipment that let you offer services. Maybe it is renovating a property to increase its value. The principle remains the same. Money sitting still is money dying. Money in motion creates opportunity, but there is a crucial foundation you must build first. You need an emergency fund. This is non-negotiable. Before you invest a single penny, you need 3 to 6 months of living expenses in an easily accessible account. This is your safety net. This is what stops you from having to sell investments at the worst possible time when life throws you a curveball. And life will throw you curveballs. Cars break down, boilers fail, jobs get lost, emergencies happen. Your emergency fund is what allows you to invest with confidence because you know you can handle the unexpected without touching your investments. Once that foundation is in place, then you deploy. Then you put money to work systematically and consistently, not based on whether the market feels high or low, not based on what some talking head on television says, based on a plan, based on discipline, based on the understanding that time in the market beats timing the market every single time. Here is another truth that might sting a bit. The reason most people stay broke is not because they do not earn enough. It is because they do not understand the difference between assets and liabilities. An asset puts money in your pocket. A liability takes money out of your pocket. Most people spend their lives accumulating liabilities while thinking they are building wealth. They buy cars that depreciate the moment they drive off the lot. They buy clothes that go out of fashion. They buy gadgets that become obsolete. All liabilities disguised as assets. The wealthy do the opposite. They acquire things that generate income or appreciate in value. Rental properties that produce monthly cash flow. Dividend-paying stocks that send checks regularly. Businesses that generate profit. Index funds that grow steadily over time. They understand that true wealth is not about what you own. It is about what owns things for you. It is about building systems that generate money while you focus on living. Let me share something that might shock you. There are people earning £30,000 a year who are building more real wealth than people earning £100,000 a year. How is that possible? Because the person earning $30,000 invests 15% of their income consistently, while the person earning $100,000 spends everything and then some. Income means nothing if you do not know how to deploy it. Wealth is not what you make. Wealth is what you keep and what you grow. This brings me to the most important point of everything I have shared with you today. The gap between financial success and financial struggle is not intelligence. It is not luck. It is not even income level. It is education and action. Most people never learn these principles because nobody teaches them, not in school, not at home, not anywhere. They stumble through life making financial decisions based on feelings, based on what their friends do, based on advertisements designed to separate them from their money. But you are here right now listening to this. That means you are different. That means you are willing to learn. And that puts you ahead of 90% of the population already. Knowledge is only the first step, though. Action is what separates the dreamers from the achievers. You can know everything about investing and still die broke if you never actually invest. So what does action look like in practical terms? It starts simpler than you think. Tonight, before you go to bed, I want you to do one thing. Open your banking app and look at how much money you have sitting there doing nothing. Not your emergency fund, not money earmarked for bills. I mean the excess, the amount beyond what you truly need for the next month or two. For some of you, that might be £500. For others, it might be 5,000. The number does not matter. What matters is recognizing that this money is losing value every single day. Then tomorrow, take 30 minutes to research investment platforms available in the UK. Vanguard, Hargreaves Lansdown, Trading 212, Free Trade. There are dozens of options now, and most of them cost almost nothing to use. Look at their fees. Read their reviews. Understand what they offer. This is not complicated research. You are not trying to become a financial expert overnight. You are simply educating yourself on the tools available. Within the next week, open an account. Most platforms let you do this entirely online in less than 10 minutes. You do not need to fund it immediately. Just get it set up. Break down that psychological barrier between thinking about investing and actually being an investor. Because the moment that account exists, you have crossed a threshold. You are no longer someone who talks about investing someday. You are someone who has taken the first concrete step. Then start small. Invest £50, £100, whatever feels uncomfortable but not terrifying. Put it into a global index fund, something that tracks the FTSE All-Share or the S&P 500 or a global equity index. Do not overthink this part. Do not spend weeks analyzing which fund has slightly better performance. The difference between good index funds is marginal. What matters enormously is that you start and that you stay consistent. Here is what will happen next, and I want you to be prepared for this. The market will move. Some days your investment will be worth more. Some days it will be worth less. You will feel tempted to check it constantly. You will feel anxiety when it drops. You will feel excitement when it rises. This is normal. This is human. But successful investors learn to ignore these short-term fluctuations. They understand that daily movements mean nothing. What matters is the long-term trajectory. I know a man who started investing in 2007, right before the massive financial crisis. Worst possible timing you could imagine. He put £10,000 into the market, and within months it had dropped to 7,000. He panicked. He almost sold everything. But he had educated himself enough to understand that selling during a crash locks in your losses. So he held on. Not only that, he kept investing his monthly contributions even as the market fell, even as everyone around him said he was crazy. 10 years later, his portfolio was worth over £40,000. The crisis that nearly broke him became the foundation of his wealth because he understood the game. That is the difference between investors and gamblers. Gamblers need to be right immediately. Investors know that being right eventually is what creates fortune. When the market drops, investors see a sale. When everyone is panicking, investors are buying. When the crowd is euphoric and prices are high, investors are cautious. This might sound counterintuitive, but it is exactly how wealth gets built. You must train yourself to be unemotional about money, to see it as a tool, not as a scoreboard. Now let me address something crucial about the UK specifically, because your situation is unique. You have access to incredible tax-advantaged accounts that most people completely underutilize. The ISA, the Individual Savings Account, lets you invest up to £20,000 per year completely tax-free. No capital gains tax, no dividend tax, nothing. Every penny of growth is yours to keep. This is an extraordinary gift from the government, and yet millions of people never use it. If you invest your maximum ISA allowance every year for 20 years at a reasonable return, you could easily build a portfolio worth over £600,000, all of it tax-free. That is not speculation. That's mathematics. But most people will never come close to that because they wait. They think they will start next year when they have more money. Next year becomes the year after. The year after becomes never. And they reach retirement with nothing but state pension and regrets. Here is another angle most people miss. Your workplace pension. If your employer offers a pension match, that is free money. Literally free. If they match 3% and you are not contributing at least 3%, you are turning down a pay rise. You are leaving money on the table that is rightfully yours. I have met people who refuse their employer match because they want the money in their pocket now. They are giving up a guaranteed 100% return for the privilege of spending money on things they will not remember in 6 months. Think about that return for a second. Where else can you get a guaranteed 100% return immediately? Nowhere. Not in stocks, not in property, not in any legitimate investment. Your employer match is the single best investment available to you, and it requires zero knowledge, zero skill, zero timing. You just have to say yes, but pensions feel distant. They feel abstract. You cannot touch the money for decades, so it does not feel real. This is a psychological trap. Your future self is depending on the decisions your present self makes today. Every pound you invest in your pension now is a pound your 70-year-old self will thank you for. And that 70-year-old version of you will either be comfortable and secure or struggling and stressed based entirely on what you do right now. Let me take you inside the mind of someone who truly understands wealth. They do not think about money the way most people do. When they receive income, their first thought is not what can I buy. Their first thought is how much of this can I deploy. They pay themselves first. Before the bills, before the expenses, before anything else, they move money into investments. Then they live on what remains. Most people do the opposite. They pay everyone else first and invest whatever is left over, which is usually nothing. This is why automatic investing is so powerful. Set up a direct debit that moves money from your current account into your investment account the day after you get paid. Make it automatic so you never have to think about it, never have to decide, never have to rely on willpower or discipline. It just happens. You adjust your lifestyle to what remains. And here is the beautiful thing. Within 2 months, you will not even notice the money is gone. Your brain adapts, your spending adjusts, but your wealth keeps building in the background without any effort. I want to tell you about James. He works in retail management, earns about £32,000 a year. Nothing spectacular. But 8 years ago, he set up an automatic investment of £200 per month. Every single month without fail. That money moved into his investment account. He never thought about it, never debated it. It just happened. Today his portfolio is worth over £24,000. He contributed just under $20,000. The rest is growth. But more importantly, he has completely transformed his relationship with money. He is no longer living paycheck to paycheck. He has options. He has security. He has a future that looks fundamentally different from his present. Now here is where it gets really interesting. Once you understand these principles, once you start seeing money as a tool rather than a possession, everything changes. You start noticing opportunities everywhere. You start seeing the world through a different lens. That coffee you buy every morning, that subscription you forgot about, that impulse purchase at the supermarket, you do not stop enjoying life. You do not become miserly or obsessed, but you start asking a different question. Is this worth more to me than what this money could become? £5 spent on coffee today is just £5, but £5 invested today at 7% annual return becomes £10 in 10 years, becomes £20 in 20 years, becomes £40 in 40 years. Now multiply that by every single day, every single week, every single month. Those small decisions compound just like investments compound. The difference is most people compound their spending while wealthy people compound their assets. But let me be absolutely clear about something. This is not about deprivation. This is not about living like a monk and never enjoying anything. That is miserable and unsustainable. This is about consciousness. This is about making deliberate choices rather than defaulting to whatever feels good in the moment. Buy the coffee if it genuinely brings you joy. Skip it if you are just doing it out of habit. Spend money on experiences and things that truly matter to you. Cut ruthlessly on everything else. The wealthy spend lavishly on what they value and cut costs mercilessly on what they do not. Most people do the opposite. They waste money on things they do not care about because they never stop to question their spending. Then they feel guilty about spending on things they actually want. It is completely backwards. Here is a framework that changed everything for me. Divide your spending into 3 categories: investments, necessary expenses, and lifestyle choices. Investments come first always. These are things that grow your wealth or increase your future earning power. Necessary expenses are things you truly need to live: rent, food, utilities, transportation. Lifestyle choices are everything else: entertainment, dining out, holidays, gadgets, clothes beyond basics. Most people never separate these categories. Everything feels equally important or equally justified. But when you break it down, you realize that maybe 60% of your spending falls into lifestyle choices. Not necessary, just choices. And that is fine. You are allowed to make those choices, but make them consciously. Decide what percentage of your income goes to each category and stick to it. Maybe it is 20% to investments, 50% to necessities, 30% to lifestyle. The exact numbers depend on your situation. What matters is having a framework. Without a framework, you are just reacting. Reacting to advertisements, reacting to social pressure, reacting to emotions, reacting to boredom. And reactive spending destroys wealth faster than almost anything else. Deliberate spending, even if you spend quite a lot, still allows you to build wealth because you are in control. Now let me address debt, because I know many of you are carrying it. Credit cards, personal loans, car finance, maybe even payday loans. Here is the hard truth. High-interest debt is a financial emergency. If you are paying 18% interest on a credit card while your money sits in a savings account earning 0.5%, you are bleeding wealth every single day. That debt needs to be your absolute priority before you invest anything beyond your employer pension match. Pay off high-interest debt aggressively, not minimum payments, aggressive payments. Cut everything you can cut and throw every available pound at that debt. Because paying off an 18% interest credit card gives you a guaranteed 18% return. You will not find that return anywhere else without enormous risk. Once that toxic debt is gone, then you can focus on building wealth. But trying to invest while carrying high interest debt is like trying to fill a bathtub while the drain is wide open.